What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
AI definitely been a big topic this week, but so has rates.
When has AI not been a big topic?
That's true. It's been a big topic for a few years now, though you have seen some changes underneath the surface, and maybe we'll talk about that today. But coming off the Fed meeting last week, we've definitely seen rates pull back some. What are your thoughts on that? Where are we going?
Yeah, I think that's one of the bigger debates right now going on the market. And it is, in a sense, part of the AI story because it's part of what's driving AI leadership or lack thereof in terms of leadership. And you've got an earnings backdrop in the AI story that is explosive. And so there's no part of the market that's going to catch up to that on an earnings perspective. And the way we've seen the market broaden out, despite that, in periods over the last year now, is when interest rates decline. And that's what we've seen now since really, I don't know, going on about 5 or 6 weeks. The 10-year yield peaked in May 19th, May 20th at about 468. And then we basically had two events that pushed rates up. We had a good payroll report, and then we had about a week and a half later. And then, of course, we had last week's FOMC meeting, which certainly pushed rates up as well. But as we sit here a little bit more than a week later, 10-year yields are now below where they were before that Fed meeting. 2-year yields are down to 408. They had gotten as high as 420, I think, in the day or days following Kevin Warsh speaking in his first FOMC meeting. So there continues to be a big debate in terms of where interest rates are headed and where inflation's going. And as we've been writing about for about 6 weeks now, that we expect interest rates to decline on the 10-year yield. A tactical call, not like a 12-month call, but more like a 3 to 5 month call. So I think we're about 1 month into that. But one of the charts we had in our weekly video that we send to clients was this chart of Bloomberg's time series of Fed speak, which demonstrates the relative hawkishness or dovishness of the words that is coming out of the Fed. And that has spiked up over the last few months, and it's spiked up in the days following the FOMC meeting last week. And you've got that going straight up, while at the same time, a series that typically correlates with that, 1-year inflation swaps, has come crashing down. So you've got this big divergence between what the Fed is saying and what the market is saying.
What are your thoughts on what you've seen in the 10-year and then what you're talking about with the hawkishness of the Fed? You've seen Fed fund futures move this year from expected cuts to hikes. How do you reconcile those themes, and what's changed with the Fed? Why are we seeing this disconnect?
I think one of the clear differences between Chair Powell and Chair Warsh is how Warsh does not want to create forward guidance. He wants to speak less. And that certainly came across in the Fed statement. I asked my Claude program how many words were in the FOMC statement about a week and a half ago. And I think it was 114 words in the first Warsh FOMC statement. Now, if we look back at the average number of words in the FOMC statement going back to 2022, that's averaged about just under 300 words. So it's about a third of the size of the statement. So he's doing what he said he was going to do. But you know what? Sometimes less is more. And the issue is that, and this is ironic maybe, that Warsh is trying not to create volatility in the market or not sway the market by forward-looking statements. But in a way, he's still pushing the market to react. But now that it's really loaded on backward-looking statements, i.e. the data. If you look at that Fed Speak series I mentioned, and I posted it on X on Friday, it is following the data. When we look at CPI, we look at prices paid data, inflation surprises, all things that have gone up in the last several months. So it is reflecting the data, but the disconnect, though, of course, which is something that Warsh did not speak to, is that you've got gasoline prices now below $4. You've got oil hovering around $69 in the US. Urea prices have collapsed. Inflation swaps, whether it's 1 year, 2 year, 5 year, 10 year, have collapsed. The 10-year yields come down. The 2 year yields come down, as I mentioned. So there's the pricing of the short end of the curve, essentially, or even the future of path of Fed funds rates, typically moves along with the macro data and moves along with Fed speak, but also gets whipped around by the market data. And again, and that's because the Fed speak is usually a function of both the market data and the economic data, whereas today it's, or at least thus far in Warsh's term, it's all been really focused on the economic data. So hence that big disconnect here. So my 2 cents is, and we'll see how things play out, that Warsh is not actually as hawkish as people think. I just think people are looking at him the same way they looked at Powell and say, look, he was really hawkish. He didn't even talk about, look, gas prices were falling in that presser, or the strait is opened up and oil prices have come crashing down. So they're just listening to what he does. And that's why we got to a point following the Fed meeting that the market was pricing in a hike in October and December. This past week's PCE data came in a little light on the inflation data. That helped to explain why rates came down a little more. So that's why the market's no longer pricing in as many hikes as it was 2 weeks ago. And the market's now only pricing in just under 90% chance of a hike in October and potential for a small fraction of another hike in December. But I think that number is going to go back towards zero, and the Fed is not going to hike this year, but it's going to take economic data, CPI, PPI, import prices, et cetera, to come out more dovish, which will then, I think, allow, under Warsh's own framework, to speak to that dovish data, which we believe, I don't want to say we know, but we believe that we're going to get some pretty soft inflation data in the next couple of months. Likelihood that we get a 0 on headline CPI on July 14th, and also potentially some lighter core data as well. So I think as the data reflect the market prices and the commodity prices that have come down, and that shows up in the macro data, which of course usually take 2, 3, 4, 5 weeks, we're going to hear a less hawkish Warsh. And that means that the Fed speak that Bloomberg publishes, that data series, is likely to come down, not up, get more dovish, less hawkish. And the pricing of the hikes that are still in the market for this year, I think, also decline as well. And I think that is the next stage of what could pull down 10-year yields a little lower. I think thus far it's mostly been about falling commodity prices. And the next stage of that, the next leg of a decline I think we could see in the 10-year that could push us to 4.25 or maybe below, is going to be when that data show up and Warsh sounds less hawkish.
With falling prices, are we likely to see a bit of reprieve in some of the consumer sentiment data that tends to follow the inflationary path?
Yeah, and we've already seen it. Consumer stocks have been some of the best performing stocks since May 20th. Housing, the XHB, the ITB, the XRT, it's the retail ETF. In fact, if you look at the best performing industries since May 20th, there's no AI in there. It's banks, transports, consumer durables, apparel, services, materials are in there, utilities. You don't see semis at the top of the list. You don't see hardware. You don't see the tech sector. So you've had this dynamic where the AI trade has become really volatile. I look at my Bloomberg screen every day and see Western Digital and SanDisk either up or down almost 10%. So these swings are getting pretty wild, and that volatility is going to force some investors to reduce their exposures because of that increase in volatility. At the same time, we have the 10-year yield now sitting at about 436, 437, which helps to explain why the market's broadened out and rotated for now the last 5 weeks. And so under the surface, the S&P has done nothing. We're sitting here Friday recording this, and the S&P is at about 73, 73. And the RSP, or the equated S&P, is hitting all-time highs. The Russell 2000, same thing. We're all accustomed to looking at the Qs and the SPY, SP 500 ETF. And some people may look at the market and say, look, the NASDAQ's had a really bad week. The S&P 500's not really doing anything. Meanwhile, there are a lot of stocks that are going up, and you're seeing that in the breadth data of the market.
You wouldn't know what's going on underneath the surface by turning on CNBC or one of those other financial programs. They seem to just want to talk about AI, but there's a lot going on. With the improvement in data this year, earnings have just been spectacular and broad. Again, those big companies and the Mag 7, their weight is so enormous. So obviously their earnings contribution is going to be big, but you're seeing it from the 493, as people like to call it.
Yeah, I think it's funny you mentioned the Mag 7 because if you look at the relative performance of the Mag 7 over the last 30 days, it's had its worst relative performance over the last month since that term was born at some point in 2023. So the RSP has outperformed the Mag 7 really sharply. And the relative performance of the equated S&P versus the Mag 7 is sitting at a 1-year high right now. So again, S&P doesn't look like it's doing so great in the last few weeks, but that doesn't mean the whole story on the stock market is really about that. There's a lot of opportunities under the surface because you do have earnings breadth improving across large, mid, and small caps. Yeah, most stocks are not anywhere near the type of earnings growth we're seeing in the tech sector, but you are still seeing more stocks seeing upward revisions than at any point over the last 4 years in small caps and in large caps. And if your earnings aren't strong enough to keep up with tech, how do you outperform? You need multiple expansion and improving earnings. And that's what's happened over the last 5 weeks as interest rates have come down. The broadening trade is really not just about broader macro and earnings data, which we certainly have. You also need to see some PE expansion. So that's why I've been saying the broadening trade needs rates to stay flat or certainly go down to continue. And I think we still have another few months as the market rotates the narrative around all these rate hikes this year. And as I said earlier, Warsh doesn't sound quite as hawkish as that data roll in. Our economists, Nancy Lazard and Jacobina, believe that core inflation could get down to around 2.3% by year end and headline at about 2.9%. And so if we get even close to those numbers, we're probably not seeing rate hikes priced in. And we're probably looking at a 10-year that's closer to 4% again and mortgage rates that are below 6. I'd say that's the probability of that is not low. I'd say it's fairly meaningful. Obviously, there's some path dependency on that. Do things heat up again in the Middle East? Does the labor market strengthen a lot more from its already 7 or 8 month period of improving data, which could push interest rates up and again, somewhat upset the broadening trade? We'll see. But base case is that we've seen a lot of upside surprises in inflation and labor data, and that helps to explain why the 10-year yield is up over the last 6 months. But I think that's also peaking as well.
More to go potentially on the downside for rates.
Yeah, again, I get it's a tactical call. And yes, I recognize the economy's strong. Yes, I recognize there are some inflationary pressures, but market prices are not just about the data. They are a function of the data and where the expectations of that data are. So the expectations today on inflation and employment are drastically different from where they were 8 months ago, when sentiment or consensus was expecting a negative payroll print back in October of 2025. And the market was pricing in 2 rate cuts in the coming this year, basically. And so now we're pricing in more than 1 rate hike in 2026. And the last payroll report, the consensus number was 85,000, quite a different number from a negative expectation consensus had back in October of last year. So expectations have shifted, and that means the bar for a negative surprise on inflation data or labor data is a lot higher today, which suggests that there's an asymmetric potential risk reward in terms of rates. And I think they're going to continue to go lower. We're about 30 basis points off the highs from just about a month ago. And I can tell you, this has not been an easy call to make. There were not too many people that agreed with us. Just go look at the comments on X. I was on CNBC and Fox a bunch of times in May talking about this. And here we are now, and rates are down a bit, and the market has rotated. And whether or not it continues, I think will be a function of that macro data that's coming over the next several weeks.
Outcome minus expectations equals happiness. And it plays such an important role in markets.
Absolutely.
That is why small caps are doing well. Are their earnings growth what tech was? No, but the expectations were much lower.
This year, where small caps have done really well, despite interest rates going up, that wouldn't have happened. And that didn't happen in 2023 or 24 or the first half of 25 because there was no earnings growth. And as we look now, we have small cap earnings estimates for 26 and 27 at the highest levels they've been this year. And if the economic data remains strong, which we believe it will, and the ISM manufacturing index keeps moving higher, which we believe it will, those earnings estimates likely continue higher, making an area like small caps more resilient from macro risks, whether it's rates or inflation pushing higher. And that said, rates coming down, I think further propels the excitement that the economy can remain healthy and inflation won't be so high. And so there's, again, an asymmetric payoff within small caps or smaller caps. And that's why we continue to prefer equal weighted mid cap and small cap relative to the AI heavy S&P 500 and NASDAQ.
So continued positive outlook on the data, on markets, on earnings, unless we see some sort of geopolitical exogenous event throw a wrench, which this year there's been plenty of those.
Yeah, I just think you have to have a diversified set of names in your portfolio, i.e., in other words, don't just be betting on rates going up or down or AI booming or busting. And the AI story is definitely still very strong, and the earnings numbers continue to just blow things out of the water. We saw that with Micron this past week. And so I expect that we're going to continue to hear about increasing demand and supply bottlenecks that are pushing price higher, which of course is leaking into some of the inflation data. But at the same time, we do have other parts of the market that continue to be attractive opportunities, even if they're more tactical, like the story about rates coming down that we've been talking about now for 5-6 weeks, and the ISM going up too. And there's a lot of names that are classic ISM plays that are doing really well. And there's even some of those names that are also in part of the AI story, of course. So finding names that have a diversified set of tailwinds, I think will become increasingly important in the back half of this year.
Great. Thank you, Michael. We'll see what the summer brings.
If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.